Hello, everybody, and welcome to week 29 of 2025 of the Build Weekly Roundup. You've got Matt Dines here with me, Cameron Otsuka. I'm glad to be back. I've been out of office for a couple of weeks now, so I missed two of these recordings. But I know Dave picked up the torch and was doing a good job of making sure he could record with Matt, getting Matt's thoughts out there, getting Build's kind of viewpoint on monetary policy, markets, Bitcoin as well. So happy to be back. I think we've got a lot going on this week, as always. To start us off, we have a few different pieces of trade policy coming out of the White House, really focused on rare earth minerals. I know Matt's going to want to dig into that a bit. Uh, Congress has dubbed this week Crypto Week. There's three different bills all running through the House of Representatives right now. The Genius Act, Clarity Act, anti-CBDC bill. So we'd like to kind of touch on those. As of today's recording, today is the 17th, so they're actually still in session. So if there's some breaking news while we're recording, I'll make sure we touch on it, but we'll most likely kind of just update you on what's going on there. And then finally, ending today with the in quotes shadow Fed. There's been a lot of talk from the Trump camp over Powell, and we're going to want to dig into kind of what we saw in the market as that happened. So without further ado, let's go ahead and get started. So,
Yeah, well, welcome back, Cameron. Everything has changed in 2 weeks. We've got, a big trend change of the dollar. Things are happening. So glad to have you back and well rested for your midsummer break.
definitely happy to
Um,
have a little bit of
we
rest.
needed a fresh team member and for all the things that are going on here.
Great. Well, let's go ahead and get started here. So, right at the gates, you've got uh, relatively recent news came out last couple of days. Trump saying he's going to set tariffs for 150 small countries. This headline in one swoop. This was really just to put out there from my perspective. You've got a lot of news of the UK working with the US on deals. You've got China still trying to work out a deal with the US. But you've also got a little bit of volatility when it comes to exactly where Trump's head is in terms of tariff rates and really utilizing it as a negotiation tactic, right? So this is just kind of news coming out of a meeting he had in Bahrain with the Crown Prince Salman bin Hamad Al Khalifa, basically saying he's going to have a flat, I believe it was 30% tariff across all of these countries, really trying to push them to come to the bargaining table, come with their own ideas on what these should look like. So just to kind of point out, the EU most recently also announced that they're not going to have retaliatory tariffs against the U.S. Kind of again as part of this negotiation, trying to say, hey, we're not going to push this further. Let's try to work out a deal, U.S. Trump, and we can hopefully come to something that suits both of us. So Matt, I'm kind of curious if you have any thoughts on what you're seeing with Trump and what he's doing with these tariffs.
Yep. So, like, first of all, it's kind of Pareto principle. 20% of anything or 80% of the outcomes is the general rule, right? You know, 20% of your time spent is driving 80% of your life outcomes, things like that. Um, and so if you think about it, right, your actual impact on imports and exports in the US, the majority of that is going to fall into like a small number of trade partners, sort descending: Mexico, China, Canada, UK, Europe, etc. So, I mean, it just kind of makes sense, right? Like, you have to negotiate all of these individual deals and relationships bilaterally, one by one. And if you're thinking about, if you're trying to do anything like run a business, trying to get scale with limited resources, right? What do? Well, sort, descend, prioritize the top of the list, and just, triage everybody else. You get this, here's the standard terms. So I think that makes sense. I think what is interesting about this today, in terms of just following the trade developments, right? We're once again being told, like, early August, right? No, no delays this time. Right? We'll believe that when we see it. Um, But in terms of actual like deals stacking up, I know the common consensus is, hey, there's nothing going on, nothing going on. But as you mentioned, there's something going on in terms of agreement between US and China. I think like, the big picture, like something that's formalized in a treaty, something like, NAFTA or USMCA, like that doesn't exist. Maybe that's a future output, but there's definitely some sort of like progress, like demonstrably being made between U.S. and China on all of those discussions. But then also this week, right? I think it was this morning we saw Indonesia pop up. So now, if you start like lining up, where are their actual like pelts taken or wins on the board? You've got something with China, you've got Indonesia, you've got UK. What's the one other big one I'm missing?
I'm blanking too right
India.
now. India, yeah.
I think we like there's some meeting of the minds on India, but if you look to mainstream media or your large financial outputs to say this is complete chaos, this is disorder, like nothing's happening, he's accomplishing very little. Well, I don't know. You might want to fade that because you've now got China, India. That's two most populous countries in the world, both large economies. You've got Indonesia, the fourth most populous country in the world added on. Then you've got the UK and all of the Commonwealth countries that they bring to the table as well. You're starting to put together, a pretty meaningful, group behind this with momentum. So it's not this, whole trade reshaping. It's a work in progress, but it's definitely not, sputtering out, falling on its face, etc. Like so far.
It's not nothing.
Um, exactly, exactly. We'll get into some of the deeper details here. But um, I think to shift gears, remember we've talked about in the past, what is the one Achilles heel that the U.S. has on physical goods, right? Imports or just dependency, right? Of any subcategory. If you just try to organize like an index, a hierarchy of goods, right? That the U.S. economy needs really boils down to like the 100% import dependency boils down to these rare earths, which we've talked about. Everybody's known about as a key bottleneck for decades. We've been hearing about this, right? So these are kind of just critical minerals that the U.S. can't produce domestically, or maybe we have the deposits or the resources, we just don't. Um, but in terms of like 21st century goods, like what it's going to take to be a winning economy here and like compete in the new growth sectors that are going to drive economic outcomes for the century ahead. It's these metals, right? And a lot of them were 100% import. Like the majority of these were 100% import, dependent on China. Maybe not because we don't have them within the 50 states of the United States, within like and inside our borders to develop, but because maybe we just don't want to do it, right? It's dirty, it's intensive, and we'd much rather have someone else take the uh, take the negative externalities, right? The pollution, the cost, the low wages, the bottom of the value chain of any good. If we can just import it for soft currency, um, you would rather do that. But that kind of that world is over. We're shifting into a new paradigm, and that's where you start to see these stories we picked up on while I think Cameron, the first one hit while you were out on vacation, but the MP materials deal reached with the U.S. Department of Defense
Yeah.
for a $400 million capital injection and 10-year kind of offtake agreement commitment for all of MP materials, production of specific rare earth elements at its Mountain Pass, California mining operations and smelter, all of that facility. This week we saw Apple come out, or it was actually late last week after we recorded. Um, the wins keep racking up for NP Materials. Apple just signed a deal, and Apple is it's a key component of, I guess, the U.S. economy, a key Mag 7, top three equity by market cap in the world. massive consumer importance to the US, and I think I'd say Western economies in general. But that key element here, production itself of Apple devices is largely dependent on Southeast Asian economies and labor, but you're also totally dependent on the rare earth elements themselves from China to just construct these devices. So this week we saw Apple execute or announce in deal with MP Materials where it would basically source rare earths from its Texas, what would be like recovery facility. It's not a mine per se. It's recovering, metals from recycled and old generation retired consumer
Breaking
electronics,
them
and
apart
basically
to
just
try to pull these
reusing.
minerals out of them.
Yeah. So essentially you're mining, you're harvesting from what you've already, pulled out of the ground. Expensive, dirty process in its own right. A lot of prior gen technologies, solar panels, tablets, phones, etc., weren't particularly well designed for, the recycling process. So I'm sure as the years and decades ahead, as it becomes apparent, we've entered this new environment, right? The global economy is reshaping, supply chains are reshaping. Maybe this will change devices, complexity, but also, building for repurposing in
Repairability.
mind as
Yep.
these repairability, all of that. Yep. But another huge deal for MP Materials, just once again providing a signpost that it's not the 100% import dependency on like goods that were really being kind of artificially lowered in cost for the US consumer because of the foreign labor arbitrage and currency arbitrage that primarily went into manifesting that. It's really now about the raw materials themselves, the commodities themselves. So it's a new world, and this is a sign that things have changed. In my opinion, is how I read this. And you're seeing this show up in the metals charts. We've talked about this, like the industrial metals, silver, platinum. Considered precious metals, but for all intents and purposes in the 21st century, I think that the value is not necessarily in this idea that they're shiny things that you want to park in your safe, although some people will choose to do that, right, as a store of value. It's really boiling down to like the industrial value or the intrinsic value, if you will, the consumer goods, the industrial goods, the military goods that these core. It's not the toys, right? We import from the Philippines or Indonesia that we're basically 100% input dependent on for board games, action figures, stuff like that for your kids. That's not going to make a dent on the import dependency on what's going on. It's the metals, like that base layer of the value chain. That's the real Achilles heel. So put the trade deals kind of in one column, but exactly next to that in your own analysis and understanding of what's going on. These metals deals are and raw commodities are right there, just as important and tied at the hip to what's going on in global trade.
In a new world, I mean, I keep hearing you say that over and over, but it truly is. I mean, when you start to think about why we want to even bring these metals, why do we want this within our borders? There's a very different perspective, right? That I think not just the Trump admin, but also broadly across multiple countries. I want to say it was Macron, I think last week. I was in Europe for those curious. I was on vacation in Europe, so I was getting a lot of European news, but Macron mentioned essentially, I'm paraphrasing his words here, but the countries with the might are going to be the ones that have the capability to win in the future of the world, right? And so as you start to think about it from that perspective, you start to see these moves with trying to find a way to wrestle some of these rare earths onto the U.S. shore, trying to find a way to manipulate or change the terms of trade between multiple countries. It starts to really make a lot more sense, at least for me, uh, how this all nets out.
If you don't have these rare earths, you don't have the magnets to produce, drone fleets or hypersonic missiles or, other, the latest gen military technologies that will ultimately allow you to you're like a nation state to persist through, this current, just call it like filtering period that, the class of civilizations goes through, you know, uh, from time to time as history
Right.
progresses. So yeah, if you don't have these rare earths, you can't defend your nation state. And so yeah, we're at that point where the rubber's already meeting the road.
Great. Well, with that, I think, again, as we talk about it's a new world, let's talk about the title of today's episode, which is really this different form of monetary policy that we're seeing that the White House currently undertake. It's very different from the way that previous admins have tried to push their policy out into the public. So Matt, I mean, maybe just explain. Let me flip us to this slide here. We saw some interesting moves in the dollar as this news is coming out. So maybe walk us through what you see on this chart, and for those who weren't kind of plugged into the market news, what is this massive dip that you're pointing out here?
Yep. So this week was kind of a trial balloon floated. I think this headline came out where, everybody with a Bloomberg terminal got it splashed on their screen. Trump floating, or he's drafted the memo to fire Powell, right? Um, and we got it was a massive sell off in the dollar. We'll go into a little bit a massive steepener as 2-year interest rates rallied, short term interest rates rallied, um, fell, right? And long term bonds. Um, I would say, I think the title of this episode, Monetary Policy Disarray, what I want to get across there is this is the new monetary policy, right? This isn't the era like that. If you're say 65 years old or and you've been a portfolio manager or involved in the financial industry for your entire career since the 1980s, that era where you're used to the Fed operating, hey, Alan Greenspan comes up and gives a speech, once a month, tells you what they're going to do, um, where the Fed funds rate is going to go, you know, talk about the economy and whatnot. Pretty straightforward, right? Then you go into Bernanke, Yellen, Powell. You're doing kind of more. You're continuing to go through the motions, keep up the same dog and pony show, all of that. I think that era is over, in my opinion. What you're seeing now, this idea, like, hey, we're actually going to float this story as a trial balloon, see how the market reacts, then pull it back as an effort to try to nudge, the key variables, short-term interest rates, treasury yield curve, and then ultimately all of the market pricing that kind of is built up on top of that. These things we're seeing like that, and that includes what we're seeing with crypto week, all of this legislation, new stable coins, all of that, where this is going. This is the new monetary policy, right? And it's going to feel completely chaotic. Um, a lot of knee jerk reactions, all of the above. It's going to be totally disorienting. But I think maybe, maybe this is, something a lot of us haven't come to grips with. This new chaos is like these are the tools, if that makes any sense. And
Yeah.
it's not because they're better tools, it's because they have to be. Like it's necessary at this point. Like we the old playbook is no longer working. And why do I say that? Your old monetary standard, Federal Reserve notes as your definition of the dollar, levered banks, capitalized essentially by treasuries as reserve assets. We're seeing the erosion of that playbook. We've talked about this extensively. After you got through the policy changes of 1960s, and then 1970, early 1970s, you rip off the band-aid, you go through an inflation, and then what the 1980s allow you to do after taking that pain is run high interest rates after you've ridden the boomer wave and the growth of the 1970s to rack up inflation and dollar debasement, and then increase economic growth, and basically debase away some of that debt burden, right, coming out of World War II, Vietnam War, all of that process. We went through like 1980 to, let's call it, 2022, right, of a certain playbook, a toolkit that worked, right? Where essentially you've got the central bank maestros, all they have to do is manage that short rate while the credit bubble builds up. We're at the point now where that old playbook doesn't work. 2022 with the hike cycle was your approach to, hey, let's try to run back monetary policy classic, um, that we grew up with. We'll make it, try to make it do everything we can, squeeze everything we can out of it, see if it's good enough. I think the answer we're seeing over the last 2 to 3 years, how the geopolitical events have unfolded, how elections have unfolded, right? We're in a new world, as far as, throw that old playbook out the door. I think the that era is probably over, and what you're seeing right now, the direction Trump and Bessent are taking things, um, is your signal that that's happening, right? On top of everything they've done to shake up the international trade side
Right.
of the financial system, right? But I think your step here. Why do I say that? Well, you're seeing that, the ability of that old system's capability to fund the federal government, like to keep it financed, stock it with money, a monetary standard that allows it to purchase the resources it needs to accomplish its objectives, right? And what are those two, or what are those things? I boil it down into two categories. It's make good on your existing IOUs. So your Social Security and Medicare are your big ones. Throw defense in there as well, because you got to defend your nation state. Otherwise, you will be co-opted, absorbed into another more powerful entity, conquered, et cetera. And then your interest obligations on your existing debt. And we're seeing that break down. So that whole monetary framework, it's like we're living through the process, all of this chaos. Um, that ship is just so slowly sailing away, and it's going to become uh, less and less relevant as we enter this new monetary policy, which is, I mean, a part of the tools of managing the existing kind of institutions. If we want to try to uh, recover what we can out of those, salvage them, and carry them forward into the future. Um, we'll shake up governance, all of that, banking policy. But then it's also, you see where the puck is going. The Genius Act, Crypto Week, all of those policies. What's actually going on is you're seeing the foundations y- being kind of laid, as far as like pouring concrete onto a new monetary standard for the future, so that um, the nation state, the dollar, et cetera, can uh, accomplish its goals, which basically means keep going, right? Like any evolutionary organism, it just wants to survive, right? So very long-winded, but big picture, that's what's going on. Get used to the chaos, right? Embrace it, because that is your new policy. Um, so the trouble in this week, right? You see that announcement. Trump's got a memo drafted. Oh, what happens? How do markets react? Dollar immediately sells off. We'll get into the big picture on the zoom out chart for the dollar. But what the administration saw, or what did you glean from running this experiment, right? You got a data point that shows the market's not going to, like, the dollar's not going to crash. Treasuries are, they'll soften, right? The yield curve's not going to like it, but you're ultimately like, this wasn't a catastrophic, like unweatherable type of damage inflicted situation. Why do I say that, right? That's a big down candle, right? That you're looking at middle of the day, yesterday, July 16th. If you go to 2 years, 30-year spread as well, this is basically the long end of the yield curve minus the short end. You saw the 30-year treasury, the long bond, once again sell off. It broke 5%, didn't hit a new high for the last 20, 30 years, that type of look back window, still sold off pretty sharply. And then the front end rally, 2-year rates come in. That's the expectation. Whoever replaces Jerome Powell is going to come in, cut interest rates, and deliver those rate cuts that President Trump has been essentially harassing, if you will, Jerome Powell publicly to, give the U.S. Treasury some help in meeting its on its own cost structure or income statement, lower that interest expense to help the Treasury's fiscal situation out. So what we saw is, again, the market response was a steepener, and it's a big move, about 10 bips from point to point, one candle. It's a massive hit in the bond market, right? But it wasn't catastrophic. You didn't see market collapse. So what I would view this as is essentially it's a test run, right? What's going to happen? Ignore the Powell situation. Powell's going to be out the door next May, regardless of what happens, right? He could be the healthiest individual in the world. There's certain things that can happen, at any age for anybody. Like, health is not a guarantee. He could leave the role regardless of whether it's voluntary, involuntary, by next May. But at the very minimum, I think what you're saying is Powell, he's ready to retire, right? He's been in this seat for, think it's like 8 years, 9 years. He's been through COVID. He's been through 2022. At some point, like, you've done your time as a public servant. You want to walk away, and sure, maybe he does not get along. Like, he's probably not best friends with Donald Trump. They're never going to be, um, super close individuals, and I don't think anybody would expect that. But I think part of what you see going on is we need a narrative behind how are we going to get the next round of rate cuts accomplished. And this is basically your tool, or like your forcing function, if you will, your actual, like, delivery mechanism for getting the last 50, 100, 200 bips out of the front end of the US Treasury yield curve, which accomplishes the US Treasury's goals for what it needs to see to improve its own fiscal position, right? Lower that interest expense has got to be mission number one. So I think if you're viewing this as a test, right, it looks like a passing success, as crazy as that sounds.
Yeah, I mean, if you even look at kind of coming out of it, right, that people have asked Trump, well, where do you stand now? And he's basically just said the same thing. Like, I'm not trying to fire Powell immediately. He's gonna leave in May. But along those same lines, as I move slides here, you've got another person kind of coming out, starting to say things about maybe what he would do if he was a Fed president, kind of what the next step might look like. And I'll just read the quote because I think it's interesting. This is from Kevin Warsh. We need a new Treasury Fed Accord like we did in 1951 after another period where we built up our nation's debt and we were stuck with a central bank that was working at cross purposes with the Treasury. So I think that right there kind of tells you, again, it's the telegraph of here's where the puck's going to move, here's where we're hoping to get things to go. wink, wink, nudge, nudge. Can you help us get there, right? So I think that's kind of just another kind of step along that path that you're laying out there.
And honestly, I have no idea why Kevin Warsh even wants this job. Like for background, for what this job is, like you are the beating horse. Like honestly, like to go into this institution, I guess you could say if you can guide the feds and the legacy banking system and the franchise it represents through this critical era. Some would call it a cartel, right? If you can do that, maybe there's some, historical legacy polish, that maybe has brought to this role. But let's be honest here, you're just Donald Trump and the Treasury Secretary's whipping boy, in my opinion, in this role. So Kevin Warsh, to me, like he's an actual serious person. He's extremely accomplished. Stanford undergrad, Harvard JD. I want to say he's got a PhD from MIT, maybe in economics. I'm not 100% sure of that one, but he was like back in global financial crisis era. Kevin Warsh, I think if I'm right, he was the youngest appointment in history to the Federal Reserve. I guess at 35, right? So he's very accomplished at a young age. And this could be, he's like, well, these are just kind of the legacy classic jobs. It's like, taking over the University of Alabama's head football coach job after Navin or Bear Bryant, right? It's like it still holds that lore, but you may not get the same results era that you're operating through.
Right.
My so yeah, zoom out here. Is like I have no idea why Kevin Warsh is actually like thrown for this job. I think the other leading candidates, um, you've seen the Scott Bessent name floated as. I don't know if he would wear both hats at the same time. That would be an interesting situation. It would feel kind of Argentinian or Latin American style currency if we had the head of the central bank and the treasury,
As the same
same
person, yeah.
individual wearing both seats. Who knows? That would not be a positive either. But then you see like other names represented. I'm much more like your typical yes men who I think from a character standpoint is exactly what's going to be required out of an individual heading the Federal Reserve in this next era. So I mean, keep watching this. The story is going to develop out and try not to think of it as a soap opera, but try to view it in terms of what is the objective uh, that these institutions are looking to accomplish. And top of that list, number one, lower rates on the front end, where most of the treasury financing and new money that it's issuing as far as like debt issuance is coming in. That's objective number one. And then I think the headlines are just your soap opera or pro wrestling type of week by week developments to get you to that eventual
The story
outcome,
beats
at
along the
the end
way
of
to
every
get
job.
you to where you want to go.
Yeah, that's exactly what's going on in my opinion.
So let's then move to Outlook here. So, the first slide I'll move over to is Dixie. So previously we had kind of that intraday chart where Matt explained that news, but walk us through I think you said the horoscopes for men with the technical analysis here. I'd love to kind of hear your thoughts
Absolutely.
on, why these support lines and kind of what you're seeing in the chart here.
Yep. So I think Cameron, while you were out, we had a good first half in review episode where we talked about the dollar, the downtrend. Essentially, all of half one of 2025 was about this sell off in the dollar. Is the worst start to the year in the dollar since 1973. It's an important year, right? It was basically when we locked in the last trade deal with China, right? With Nixon and Kissinger kind of coming to the handshake agreement, representing the U.S. Um, with Mao and the Communist Party of China. But what was really going on behind the scenes, if you tune into our episode 2 weeks ago, which had horrible audio quality, but was extremely well done in terms of content, apologies for that, everybody. But basically, what you're seeing in that downtrend in the dollar was a series of financial transactions, which ultimately just nets out to the US was essentially foreclosing on European gold and margin calling uh, its physical delivery back into the continental US. So taking delivery back into New York with physical would be hitting the JP Morgan vaults or BNY, et cetera. So that trade, right? If you think about it, we walk through the sequence of trade. That really represented what was going on. Dollars being kind of lent or sold into Europe. Um, those proceeds being used to buy euro or British pounds. Those British pounds going to exchanges for physically settled gold futures or spot markets, and then at settlement, those gold bars get put on a Boeing 787 and airlifted back into New York. Essentially, that sequence of transaction was driving the dollar lower. And this is very clear in the imports data in the US, the balance of trade data between the US and countries like Switzerland, United Kingdom, et cetera. So, what we've seen, the bottom of this chart, you've got the lower end of the bullish channel that the dollar has been on in the entirety of the post 2008 global financial crisis world, right? So dollar, despite all this narrative being out, right, death of the dollar, de-dollarization, dollar is actually trending up. It is strengthening versus your other developed market, competing currencies in terms of large international money center representation and GSIB, globally systemically important bank kind of representation. Dollar in the long run trending up versus euro, JPY, Japanese yen, etc. So right at the end of half two, right, we saw the DXY index hit that lower bound. And we talked about this on the episode, saw some tweets from me on this. This has been essentially make or break. It was either going to break that channel here and there was more sell off in store, or we were going to expect to see a bounce, right? But whatever was happening there right at the bottom of that trend line, it wasn't a sustainable spot. It had to move one way or the other. And what we've seen the last 2 weeks in the dollar is actually the bounce, right? So that kind of sell off has been arrested. Dollar's found support. It's crossed over the the resistance line, and then yesterday on that trial balloon, we zoomed in more and we kept just doing the minority report, enhance, enhance, enhance toward that green arrow. What you would see is yesterday's sell off that was driven by this trial balloon that someone in the Trump administration floated off that they had the Fire Powell memo drafted. Saw that sell off on the dollar, pull back past that resistance line that it just broke through and rally off of it. So you've seen this kind of classical concept in trading where previous resistance becomes support, or you can see vice versa, prior support becomes resistance. That's indicative of a continuation chain, or like a reversal, right? So I would expect right now the natural state of the market, dollar wants to be bullish from here. We don't know how far, right? Is this thing going to rally to, what I've kind of extended in the dark green range there, which would be the low end of this post 2008 post GFC bullish channel. That would be your base case, that we rally within that, but we stay within that easing period. Why do I say that? Well, we're clearly at the point of the dollar credit cycle where it's what do you call it? It's like the trough, right? interest rates want to rally, economic growth is slowing down. Some of the indicators you're looking for here is like the commodities market um, wants to keep prices low to ensure that the real economy just keeps kind of humming along, doesn't go into a situation like 2008 or COVID in 2020, where the policymakers have to get the paddles out in terms of like having to actually get out and rescue the patient with, a giant monetary stimulus, something like that, to spur the credit bubble back out of deflation or contraction. Right. So I think that the key takeaway here from the trial balloon is you've got a backdrop where now dollar wants to rally. And I think if you're a policymaker, you want to take the temperature. How do you know like what the state of the market is? Well, you got to test it, right? You throw a test at it. And I think from the executive branch's perspective, the Fed's perspective, the bank's perspective, but then every trader in the world who has their head on right can see this. And what it looks like now is that dollar sell-off is done. The dynamics that were allowing it to happen, which is the kind of the physical gold delivery, foreclosing on your, former friends in Europe, yeah, margining them out on their pawn shop loan, if you will, taking their gold back into custody. That whole trade dynamic is on pause for now, and it looks like this is a sign that we're in a kind of a state transition. Now, if you go to the bond market, what you saw, I'll go to camera, this is slide 9. We saw, I guess there's a lot to talk about, but long end rates on that, steepener, it was a combo, right? Long end rates sold off, so 30-year yields increased, 2-year rates came in, and that drove a steepening of the yield curve. I would call it's actually kind of the inverse or the reversal of Operation Twist, if you remember that from 13. So maybe we should call this kind of new policy the reverse Operation Twist or the rot.
Untwist.
Um, 'Cause I think rot kind of accurately describes what's going on underneath the floorboards of this entire kind of framework. But what we saw is that sell-off wasn't necessarily like to the same degree of steepness that we've seen on a few other iterations. You remember early April, post tariff day, first long end rates rallied and then they got
They got
smashed down.
smashed. Yeah.
It was aggressive. It wasn't anything to that degree, but it was in terms of weakness. Now, if you look at trend lines, I've got two black arrows that are the bottoms this kind of recent period that we've been in on long-term treasury yields. Number one, October 2023, right? Yeah, I'm trying to remember. 2022 was the UK pensions. 2023, I can't even remember what the close of Q3 was that drove rates higher this time around, or sorry, in 2023. But whatever it was back then, that sets the channel. It was a classic kind of end of Q3 event where you have the key bottleneck in the financial system, and then the sell off, kind of the post Liberation Day kind of bottom back in late May of U.S. Treasuries. I think the bottom tick was a significant tail on the new 20-year auction, right? So Treasuries broke lower on that news went yesterday about firing the current Fed chair, but it wasn't necessarily like the channel breaker at this point. So if you're thinking about this from you want to press the system, see how close you are to the boundary constraints, can you go ahead and do this? What would happen if you actually did it? That signal you got from the long end of the bond market was essentially telling like you're poking at, some, let's say it's wood or drywall. You can see it's moist. Just going through this as or not, I'm not going through this as a homeowner, but put it in perspective if you own your own home right here. constantly taking care of things. You poke the wood, you're like, hey, that's wet. Poke it harder, you're like, oh man, that's totally, we're gonna have to take out all the framing, the boards, etc. Or if you just poke it, it's like, oh, it's softer. All we got to do is dry it out. It'll recover. It'll heal. You kind of got the sense it's like, hey, this is actually not, completely, mush. Like I'm not just poking into this thing and, um, there's no rigidity left, mustering up any reaction to the force that's been put up against the object. So I think from the bond market standpoint, if you're looking at 30 years, you've got that data point wasn't the right direction, right? You don't want to see yields blowing out on the long end or going higher. But I think what you also got out of that as your takeaway was, hey, this wasn't catastrophic. Maybe the bond market's actually going to let me do this. I'll take a hit, but I'm actually going to be okay, right? You may see like 30-year yields will go higher if you do, remove Jay Powell. And when we say remove Jay Powell, just replace that with we're going to lower front end rates further
Right.
because that's the actual output, right? So you're going to get higher long end yields, that, but that's the cost, right? You got what's there. It's like, okay, is it going to be catastrophic? This was your signal. It's like, oh, it's not going to ruin me. I can probably get those next round of cuts, 50, 100 bips, whatever we can get them to. We can get that done. And then your benefit from that side, your treasury debt is skewing lower and lower on it and duration. So if you can lower your interest cost on the front end, your cost to benefit ratio is starting to look very good to actually execute that policy you just put out the trial balloon for. So I think that's what you saw this week. Reading between the lines, but going back to that original, this new wave of monetary policy is not going to look like the kind of polished, suit and tie uh, press conference, white paper driven kind of format that we've become used to from 1980 to 2020. Let's call it 2024.
A very different way to run monetary policy, that's for sure.
Yep. And then we didn't talk about this a lot, but this was crypto week, right? And you've seen, one of the hottest equities in terms of performance this week has been that Circle IPO, which hasn't gotten back to its all-time high that it hit in mid-June. But this week was that Circle stock price was a big mover higher, like big moves on the up days, big moves on the down days. From a trading perspective, that means there's, something underlying taking place. Price discovery is in the works. But if you zoom out, what's going to happen? This Genius Act is going to get delivered. It's going to get shipped. You're going to have stable coins. There's going to be a bunch of T-bills stuffed into these stable coins. Someone is going to buy these stable coins and own them on their crypto wallets. That's going to be where your T-bill supply gets absorbed. And then ultimately, why do these stable coins matter? Well, if you look at actual Bitcoin market prices, right, and you go on to, the summaries of all the, global exchanges, you got Coinbase representing the US's franchise, you got Binance representing China, got OKX representing the UK, and et cetera, right? You look at all the Bitcoin to dollar trading pairs. Really, the only one where you've actually got that Bitcoin to dollar price that we're all quoting, like 120K. Like we talked about this last week, Cameron. So the breakout on Bitcoin, that's been covered. So we won't get too much into Bitcoin price, but what is the actual dollar that spot market is quoted against? They're not all the same thing, right? Most of your spot exchange activity, Bitcoin to dollars, is actually mark to market. Like the trading pair is Tether,
Right.
is the countersign.
Right.
The only large exchange, there might be one more, but it's really Coinbase to USD. Like when we say USD, a Fed member bank FDI insured dollar deposit, right? As your trading pair to Bitcoin. So what's going to happen here, if you just ramp up stable coin supply because it's somewhere where you can force feed a bunch of new T-bill issuance, and then the hope is, um, Latin America, Africa, other developing countries will just kind of absorb kind of US led and operated dollar monetary policy, like through this new, I guess, crypto distribution, right, on these open rails. That's the idea, or the idea is like that's what's going to be this kind of next decade or generation ahead of essentially monetary policy, right? It's your new toolkit, your new framework, which is also kind of, if you're going into the Fed's framework, you've got to think about how you're going to update your franchise to live in this kind of brave new world. Now, what's the actual like impact? Like just thinking 2, 3 steps ahead, what happens when we increase supply of stable coins, right? And you're going to see a bunch of USDC, bunch of, I mean, Tether will kind of reformat itself to comply with Genius Act, or have two
The
competing Tether
separate,
products, right?
yeah.
One Genius compliant, one offshore kind of managed Tether Classic. And you're just going to see a proliferation of stable coins. Where is that liquidity ultimately going to show up? It's going to show up where it's exactly where it's been showing up, for the last 10 years since Tether has been, as Tether has been materializing, as crypto exchanges have been materializing. It's going to all flow into that Bitcoin to Tether or Bitcoin to stablecoin exchange rates, right? Which ultimately the net of all this, assuming all of this happens, if A is true and B is true, then you lead to this conclusion, C is true, and that C is that dollar liquidity is ultimately going to show up, lifting the offer on the Bitcoin to stablecoin trading pairs, which are the majority of Bitcoin liquidity. So it's going to drive up a higher Bitcoin price. The ultimate facts of where this is going.
I 100% agree with that. I can't imagine a world where I've been trying for myself to try to kind of test my own theory on this too, and I can't think of a way that this doesn't actually equate to a positive in terms of, for Bitcoin holders, this seems like the obvious outcome, but
Yeah.
we'll see.
It'll work through the credit bubble in terms of the dollar system. It will, so the volatility inside of the Bitcoin to dollar exchange rate, that'll materialize the same way it hasn't, or sorry, the same way it has through all assets for all time, broker dealer supported securities, this new wave. It's same thing, just change the nouns, change the legal artifacts. There's really nothing new under the sun. The volatility of the drawdowns, they'll still exist through credit creation, through the collateralization, through the liquidity injection, all of that. It's still going to be there. It's just kind of new names. And then I think under the hood, the really important thing is the actual like sturdy new foundation underpinning capital markets finance, like the actual, you
Collateralizing
know,
on Bitcoin instead.
yeah, like that is your actually like deeply embedded, skyscraper grade foundation that you can build massively and like deep, and towering structure on top of. I think that's the actual trend going on, but that's the one you have to see kind of silently working through these headlines. So you kind of have to zoom out. Like, a lot of Bitcoiners see it, probably 1 to 3% of the population. But I think for everybody, like to see the forest for the trees, right? Like even just to understand like what you're witnessing this week with these, crazy headline, Trump trying to fire Powell, all of that. Like, wait, that's actually monetary policy being conducted. It's hard to see all of these things in motion. So, more of the story, I guess, if I can encourage anyone, watching this who isn't kind of with us already on this one, study Bitcoin, and then once you figure it out, then start building your finances, your capital kind of allocations towards that framework. And for 15 years, it's been rewarding people extremely well.
And I think that's a great place to end it then. Thanks for joining us, everybody, this week. Hope to see you all next week. I will plan to be back hosting again with Matt. For those of you who don't follow us yet, please do. We post these episodes up on YouTube. You can also find us on Spotify. And then we also post across our X and LinkedIn accounts. So, again, please subscribe if you haven't. Thank you so much. See you next week.
Thanks.